We're going to calculate the stock price for Air Canada. And the first step is we need the market cap, 4.195 billion. Then a stock price of $15.90. So now we know how many shares outstanding. We just take the market cap divided by the stock price. We get 264 million shares outstanding. Next we need free cash flow. And this is the best way to calculate the value of a company, is to estimate future free cash flow and discount that number back to today's dollars. That is what we're doing in the video today. Next we need net income, which is the profit and loss for each year. And it's positive for them for every year, which is good. It probably won't be positive next year. And last we need revenue, which is looks like it's been on a consistent increase each year, which makes it easy to value. Then we need the interest expense, because we need to figure out the capital structure so we know what to discount the cash flows by. So the interest expense of 480 million. Then we need to see how much debt they have, and we look in the balance sheet on the current debt, current liabilities, 587 million. And then the non-current debt, the long-term debt of 5.2 billion. So they have an interest rate. That's a big interest rate. Let me just make sure. Interest expense, it's all right. 8.3%. So they obviously aren't a good creditor. They're paying a really high interest rate. So let's find out the effective tax rate, because interest is tax deductible. So what's the income before tax? And now the income tax of 300 million. So 17% of taxes. So the cost of the equity, the cost of debt is 7%. And they have more than half their capital structure is debt, which is not a good sign. Now we need the cost of equity, and we need the beta for that. And yep, they have a high beta, as I suspected, 2.12. It moves more than twice the market. So the cost of equity is 18.6%. The cost of debt is 7%. So equity is more expensive than debt because equity sits lower in the capital structure of a company. In the event of a default, the debt holders are paid before the equity holders. And equity holders usually receive nothing, maybe 1 or 2 cents on the dollar. And the WACC of 11.82% is the price Air Canada pays to finance the company. And they need to generate this amount of profit each year to add value to the investors. And if they're not able to do that, then they'll eventually go bankrupt. Even if they're profiting 5% a year, that's still not enough to pay the debt. So something to think about when investing in a company. So now we have the discount rate. Let's see what the cash flows are. So the free cash flows are estimated in the future years. And then we also did a terminal value, which is all the free cash flows after year 4. We discounted those dollar amounts back to today, and we get a value of the company of 14.5 billion. And we divide that by 264 million shares. We get a stock price of $56. So it's trading at 16, so it's trading at a 71% discount. So you can see the stock was trading around intrinsic a few months ago, then it dropped a lot. So people don't always pay what something's worth because they just don't feel the stock is worth $50. It's being bought down because they see the future of the company struggling with less people traveling. So stock price could always trade well above or well below intrinsic value, but it's all based on supply and demand of the market. And you'll find some analysts suggesting this is a buy stock. Other analysts are suggesting this is a sell stock. But each analyst has their own model and their own assumptions and their own ideas on a company, on the economy. But you never actually see their model or their analysis. But this is my model and my analysis. So thanks for watching.